Welcome to the Taxes in Retirement Masterclass. My name is Bill Bloom, and I am going to be your presenter today. I want everyone to take a moment right now and type in your name in the chat box and where you're from. And the reason we're doing this to start off today is to, number one, make sure that the chat box is working, because when you have questions or comments, please type them in. And just so you know, I'm the only person who could see that. So it's private. You don't have to feel ashamed or bashful about answering questions, because there will be some engagement tools throughout this presentation, because I want you to really feel engaged and enlightened while we're going through our workshop today. And this is part one of a two-part series. Today is all about education, and on the back end, part two is all about understanding how your taxes look in your own retirement. Because everyone here today has a different scenario, a different story, and I'm here to help you navigate this whole entire process. So let's get started with today's presentation. Now, I want all of you to close your eyes. Take a deep breath. Pretend that you're out on a beautiful sailboat here in Lake Michigan, because I'm out of Chicago. And I really want you to take into consideration a beautiful day. The sun is shining. The wind is blowing just right. And then, all of a sudden, there's a wind change. And when you open your eyes, ladies and gentlemen, you see the boat that you're on looking like this. And as a sailor and a racer, this is a problem, because you don't know how to get to your next destination when your sails are tangled and mangled. It's a problem. The same could be true with planning for your taxes in retirement. Every couple of years, we have tax law changes. And I absolutely love talking about taxes. I've been in the financial services industry since 2008, so for 13 years now, and I never thought that I would love talking about taxes this much. I've been doing this for a while, and I see this all the time. People get their financial situations tangled up, just like the sails on this boat. And I'm going to teach you today ways to get you untangled so that you can navigate the life that you desire. I'm going to take 1 minute and tell you about myself, because today it's not about me. It's all about you. You invested time to be here today, so I want you to get the best return on your investment. So as you can see here, I've got a wonderful family. Our little guy James just turned 2 years old. We have a tripaw, a three-legged rescue dog named Leia, who is amazing. She's feisty, but she's a great dog. My wife Jude, she's from Argentina. And we met randomly through a mutual friend here in Chicago. I think it was a divine intervention. We were meant to meet. And I went to Ohio Valley University, and my hobbies are running, sailing, as I mentioned before. I love writing books. I've written 4 books on retirement planning, and they are all free to you on my website. So after the presentation today, I have 4 retirement books that you could read for free on my website. So I'll send that to you after the show. And I love family time and reading. Those are really some of my favorite things to do, because I love education. I'm all about educating people. And I also have a podcast that talks about money issues that can be found on iTunes and Spotify. So, ladies and gentlemen, some of the things that I am not. I want to be very upfront and very forthcoming to you. I'm not a CPA. I am not a tax attorney, but I am a financial advisor who specializes in taxes in retirement. And that's why I was asked to present to you today, because I do a lot of education in the community. And as I mentioned to you before, we have free books, podcasts, these webinars. So I just love education. So thank you all for being here. So what we're going to do right now is get into today's reality. Over 47 years ago, our landscape changed in the financial services industry. 47 years ago, tax-deferred products were created because of the ERISA laws. And I'm sure some of you know of these tax-deferred investments, such as your 401ks, your 403bs, IRAs, Roth IRAs, tax-deferred annuities. A whole plethora of tax-deferred products were created 47 years ago. And that was really a good thing, because tax-deferred means that your money gets invested, you allow it to grow, like in your 401k, for 30 or 40 years. And then when you go to take the money out, you pay taxes on that. But you haven't been taxed over that 30 or 40 year period. And that's a brilliant concept, because the numbers show Americans have saved a lot of money in these pre-tax retirement vehicles. So let's get into the numbers. Right now, Americans have saved over $28.9 trillion of money in tax-deferred retirement accounts. And folks, that's a great thing, because we're going to need that money. We're truly going to need that money in retirement. But all of this money hasn't been taxed yet. So I want you to take a moment and write in the chat box, who else do you think this is great for? To have $28.9 trillion of untaxed money. And take a moment, write that in the chat box, type that out. And I see Tom here saying, our government. Sue said the government. Yep, you are all doing that perfectly. So thank you so much. Keep typing in your answers and staying engaged with me throughout this process. You're right. This is a great thing for the government as well. And again, going back to today's reality, our federal debt is 79% of our gross domestic product. And over the past 3 years, our debt as a country has doubled. I bet a lot of you didn't know that. So over the past 3 years, we've seen an increase in printing money from the government. We've gone through this pandemic that we're still not completely out of. But Lord knows we needed that money as well to help sustain our economy. So in the future, what does that mean for your taxes? And that's why you're here today, to kind of understand what's going to be happening in the future for you. Well, I'm going to give you an example and tell you a really simple story. Imagine you have $100,000 annual income in your household, which is wonderful. It's really a great thing. And you've been saving your money, but you also spend a lot of money. You've actually overspent your money. And imagine that you owe $219,000 on a credit card when you only have $100,000 of an annual income. And folks, this is the problem that we could see with the government. In 2025, the tax laws are bound to change. So we have a couple years to help plan for future retirement income. From a taxation standpoint, there's ways to help, prevent some taxes. But right now, if the tax laws do not change, we could see this same scenario with the government where they owe 219% of debt on 100% of their income. So it's a problem. You would not want to live your life like this as well. So let's get into today's goals, because today is all about education. It's not product driven, and it's all about you. So our goals today are to give you real life ideas that you could take back to your accountant or to your financial advisor. And the folks that I talked to in part 2 of the presentation, the majority of them have a financial advisor. Let's just put that out there. That's okay. The one thing that they say to me quite often is that their advisor, he or she does not specialize in taxes in retirement. And you're all here for a reason to understand what your taxation could be in retirement. So I want to give you real life examples to help you. Second goal is to understand the impact of Roth IRA conversions on your future retirement income streams. And you will learn more about this in your own personalized part 2 session. We're going to identify tools and strategies for you that would be available for soon-to-be retirees or current retirees. So it's for everyone on this presentation. And lastly, let's have fun because, we're here to learn, but we could make learning fun, especially taxes. So hang with me here. We're going to have a great time together. Now, a lot of you are here because there's a ton of complexities when you go to retire. For those of you who have retired already, you could probably relate to this depending on your age. So there are required minimum distributions in retirement. Most people don't know when to take them. They don't know what does that mean for their taxation. How much do they need to take out? Capital gains, what's that rate? Is it short term? Is it long term? There's a lot of complexities with that. Social Security benefits. This is an important one. I can't wait to get into this part in a little bit here. And I'm going to give you a case study on the surprise taxation that I saw on a new client's investments because of a withdrawal that they made with their prior advisor. So we're going to get into that as well. Now, I would love everyone here to answer a poll question. It's going to pop up on your screen right now. The question is, at what age do you need to start making and taking your required minimum distributions? And it's popped up on the screen right now. So please go ahead and answer that. And I see that we have questions and answers coming in here. This is excellent. Some of you got this correct. 72 years young is when you need to start taking your required minimum distributions. About half of you got this right. The other half answered 70 and a half. Now, if this was a couple years ago, the other half of you would have been correct because the laws just changed. And this is why we need to navigate together the taxes in retirement because things are always changing, just like the wind out on the lake on a sailboat. So realistically, this is a very important concept to understand because if you know how your required minimum distributions work, you could think in the future and start planning opportunities to try and potentially minimize your taxation in retirement, which is, I think, what we all want. That's why you're all here. And in the bottom left-hand corner of the screen, you could start booking your part 2 of this 2-part presentation so that you could start to understand what your taxes could look like in retirement with some planning for the future. And when you click on the blue box, you'll still hear my voice. You'll still stay in the presentation. It'll just take you to a calendar link so that you can book your own time. So you won't get kicked out of the webinar. So feel free to book your time at any point during this masterclass. So when you reach 72, if you had, for example, a $500,000 balance in an IRA, a pre-tax IRA, there's always going to be a divisor. So for this case, it's 25.6. So your required minimum distribution is going to be a little bit under $20,000. And what does that mean for you? Well, this could make your Medicare taxable, your Medicare premiums, and it could potentially make other aspects of your retirement taxable as well. So I want to take a quick moment here, and I want you to type out in the chat box an answer to this question, please. And the question is your Social Security taxable? Type in yes or no. So take a moment, type that into the chat box. is your Social Security taxable? Yes or no? And I have answers coming in. I see quite a few no's here. This is interesting. So the correct answer, ladies and gentlemen, is yes. Your Social Security could be taxable. It could. And it could be taxable because of capital gains or your required minimum distributions. So one of the things that could make your Social Security taxable is a thing called phantom gains. And you're probably thinking, well, what's a phantom gain? Well, let me give you an example. Let's pretend that you bought a mutual fund in 1990. So in 1990, this mutual fund you purchased, and that's great. So you've had this for a very long time. But the mutual fund bought shares of XYZ stock 20 years before that. So they've held these stocks for years and years and years, for 50 years. So they've had a lot of gains throughout this time. And you're still holding this mutual fund that you bought in 1990. And we look in today's year. The fund manager of that mutual fund, you know what they did? They decided to sell that stock, the same one that they bought inside the mutual fund 50 plus years ago. And now there's a massive capital gain inside of this fund. And the issue is, even though you only held that fund for about 30 years, you're getting taxed on that, the whole entire gain, not just from the time that you owned the mutual fund. So these surprise taxations in retirement could really affect, your Medicare becoming taxable, your Social Security becoming taxable. And has your advisor talked to you about these things? This is what I specialize in. This is why you're here today, because you're probably missing something from your current planning. So here's how your Social Security is taxed based on your other incomes. So there's a formula called provisional income. Now, the way that this works is the IRS looks at 50% of your Social Security benefit, any ordinary income that you may have, which is the least favorable way to be taxed, like your pre-tax 401ks, your pre-tax IRAs. It's the least favorable way to be taxed. I'll show you why here in a few moments. Also, your dividends and capital gains could make your Social Security taxable, and any taxable, non-taxable interest also could make your Social Security taxable, such as municipal bonds. And here are the thresholds. This is something that everyone here needs to pay attention to. This is very important. For individuals, anything over $25,000 of provisional income, that would look to make your Social Security 50% taxable. And anything over that $34,000 threshold, you're looking at an 85% taxation on your Social Security. And you're probably thinking, oh my gosh, I didn't realize this. And again, that's why you're here today to learn. And for married couples filing jointly, anything over that $32,000 mark is at a 50% taxation on your Social Security. Anything over the $44,000 mark, 85%. So folks, you see why this is so incredibly important to understand where your income is coming from in retirement. And this is what I help my clients plan for. So this is one of those things that it's really hard to plan for. It's really hard to plan for. In this case study, this couple, John and Jane, they're married filing jointly. They're both of required minimum distribution age at this point, so they're over 72. They have $60,000 of combined Social Security. they have $15,000 of net long-term capital gains and $45,000 of required minimum distribution. So they saved pretty well, over $1 million in their retirement accounts. So what we're going to do here is show you a tax mapping strategy. And this is what you're going to receive in your part 2 of the tax mapping presentation. So you could book your time in the bottom left-hand corner right now. You'll still stay in the webinar and see this. So please book your time. Take a moment to do that right now. And for this couple, this is the real tax system of their ordinary income. At the very bottom, the green, we see that up to about right under $30,000, they're really not paying taxes on their money. But the gray box, their ordinary income, you see after the $10,000 mark, they're at an 18.5% tax level. And then when you jump over $20,000, they're at a 22.2% tax bracket. And now you see in the middle here, 49.95% taxation. This is a problem, folks. This is a big problem. I'm going to show you why. You're probably thinking, how in the world did this couple have an almost 50% taxation on a $1,000 withdrawal? $1,000. So in theory, if they were in the 12% tax bracket, which they were at the time, they would have a $1,000 additional IRA withdrawal. That should be only $120 taxation on their federal taxes. But here's what actually happened to them. That $1,000 additional IRA withdrawal caused that $120 taxation. But here's what also happened. They passed over a threshold for their Social Security taxation. And this is what I help folks plan for. This caused an $850 taxable Social Security bucket. So that means another $102 of taxation. Lastly, this caused $1,850 of their capital gains to be taxed. So that bumped them up into another bracket as well. So that equated to the $277.50 taxation on that, which totaled almost $500. So let me ask you a question. If you go to withdraw simply $1,000 from an IRA or a pre-tax 401k, would you like to lose half of that to taxes? And that's not including your state taxes, depending on which state you live in. So these are the things that we need to plan for together. These are the things that we will plan for together. This is a really devastating realization for these folks. And when we put it like that, it all makes complete sense now, right? So I know that's partially confusing, that past slide, but let's continue with this. Let's have fun. We're going to take a moment here and watch a video that really relates to what we're talking about here today. This is where our friend George Costanza from Seinfeld is going to tell a really great story, and I'm going to show you why we're going to be talking about this here in the future. So enjoy this clip.
It all became very clear to me sitting out there today that every decision I've ever made in my entire life has been wrong. My life is the complete opposite of everything I want it to be. Every instinct I have in every aspect of life, be it something to wear, something to eat, it's all been wrong. Everyone.
Tuna on toast, coleslaw, cup of coffee.
Yeah. No, wait a minute. I always have tuna on toast. Nothing's ever worked out for me with tuna on toast. I want the complete opposite of tuna on toast. Chicken salad on rye, untoasted, with a side of potato salad, And a cup of tea.
Well, there's no telling what can happen from this.
You know, chicken salad's not the opposite of tuna. Salmon's the opposite of tuna, because salmon swim against the current, and the tuna swim with it.
Good for the tuna.
George, you know, that woman just looked at you.
So what? What am I supposed to do?
Go talk to her.
Elaine, bald men with no jobs and no money who live with their parents don't approach strange women.
Well, here's your chance to try the opposite. Instead of tuna salad and being intimidated by women, chicken salad and going right up to them.
Yeah, I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes. I will do the opposite. I used to sit here and do nothing and regret it for the rest of the day. So now I will do the opposite, and I will do something. Excuse me, I couldn't help but notice that you were looking in my direction.
Oh, yes, I was. You just ordered the same exact lunch as me.
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
Okay, welcome back. So thanks for sticking with me. We're going to have another 20 minutes of this presentation. And in the next 20 minutes, it's actually the most important part of this presentation. So hope you have your pen and paper ready to take some great notes. And the reason why I showed you that clip is because I would equate, Elaine and Jerry to be George's advisors. They told him, do something different. We should plan for something different. And that's what this presentation is all about today. The financial services industry has been telling folks for so long, for over 50 years, that your taxes will probably be lower in retirement. And we all want lower taxes in retirement, right? And that may not be the case because of what we've seen in the past couple years, and our federal spending has doubled in the past 3 years. So these are issues that we have. And George Costanza went out and did something about it. He actually took action. He went up to the lady, introduced himself, and was honest, open, and that's how I conduct my life as well. Got to be open and honest. It was fascinating to see the effect that he had when he did something different. So I want to challenge everyone here today to think differently, to be open to new ideas, because this could make a huge impact on your future retirement and your taxation in retirement. So over the next 20 minutes, we're going to go through a couple concepts and case studies. We're going to talk about the 3 different types of money, which we all need to know about. We're going to talk about a thing called the widow's tax. This is something that hardly any advisors talk about, but if you're married, this is probably pretty prevalent for all of us. And we're going to go through, should you defer or not to defer your money? That is the question. So folks, I want you all to take a moment and type in the chat box here. What type of income would you like to have in retirement? And pick one of these 3 answers. Do you want to be taxed in retirement? Do you want to have after-tax money in retirement, or tax-free money in retirement? So type in your answers right now, and we're going to go into our case study. So here are the 3 different types of monies. This is all about taxation in retirement. The first bucket is your pre-tax money. Second bucket is after-tax. And your third one is tax-free. And we're going to pretend like everyone here in this masterclass bought ABC stock 10 years ago. And this stock was a great pick. We made a lot of money. It's done very, very well. And I'm going to take you through how you're going to be taxed on your gains for each type of account. Okay? So in the pre-tax bucket, you're going to be taxed at an ordinary income rate, which is the least favorable. You have 7 different tax brackets where you could be taxed in. If you look in the after-tax sphere here, this is a non-qualified investment. So you're going to be taxed either short-term or long-term capital gains. Long-term capital gains are pretty favorable because you only have 3 brackets: 0, 15, 20%. Lastly, when you go to withdraw money from a Roth IRA, even though you've had 10 years worth of gains, it's all tax-free. So going back to the pre-tax bucket, after your 10 years of gains, when you go to withdraw that money, you're going to be taxed in one of these 7 brackets. It could be up to 37%. Very high. The after-tax, again, much more favorable. We have simple numbers here: 0, 15, or 20%, or tax-free. Now, I think it's pretty clear which one is the most favorable here, folks. But I want to flip the script here for a moment. Let's think of this opposite. Let's pretend that ABC stock was your worst performing investment in your 401k or your after-tax account or your Roth IRA. Okay? So in your pre-tax account, it's a problem because you lost money. You're going to sell the stock. You don't want to hold on to it any longer. But you're still going to get taxed on this money when you go to withdraw it. You're going to be taxed in those same 7 brackets, 10 to 37%. So it's still an issue here, folks. The after-tax account, you get what's called a Band-Aid because of tax loss harvesting. So this helps you offset some of your gains that you may have if you sold other stocks that year. Lastly, when you go to withdraw the money out of your Roth IRA, this is still more favorable because even though you lost money, unfortunately, you get to pull the money out tax-free. And now let's talk what happens to that money at death. When you pass away, any money in a pre-tax 401k, 403b, traditional IRA will pass to your beneficiaries at their tax rate. So if your children are going to inherit those monies, they're going to have to withdraw that whole entire account within a 10-year period. That is one of the tax laws that has just recently changed because the government has these trillions of dollars of untaxed money. You used to be able to withdraw that account over your lifetime. Now it's 10 years. And why do you think that is? The government needs tax revenue. On the after-tax basis, you're going to have a step up, and this is super favorable. But the issue is the government is considering taking away your step up in basis. So this could be an issue moving forward, but we'll be working with you to keep an eye out for this for your after-tax accounts. And lastly, your tax-free account. At death, God forbid when something happens to you, when your beneficiaries inherit this money, it will go tax-free to them. So out of these 3 types of monies, where would you like to have your money? I know my answer, but this is something you're going to need to decide for yourself. So we're going to go through a Roth IRA conversion analysis here. This is very important. Most advisors don't talk about Roth IRA conversions because they don't understand the tax effects that it may or may not have. But this is what you're going to receive in your Part 2 presentation. It's going to be all about you to see if this makes sense or not. So in this example, we're going to look at converting a $100,000 pre-tax IRA into a Roth IRA. and you're in the 25% tax bracket. And after 10 years, we leave the money invested how it is, your accounts double. So both sides of the spectrum here, if you would have kept it where it is, you would have had the accounts double, which is great. But here's the thing. You still have taxes to be paid on the IRA. So let's pretend you're still in that 25% tax bracket. The tax laws haven't changed. Let's just pretend that for 10 years. We know they're going to, but let's just pretend here. So after you pay your taxes on your pre-tax IRA, guess what? You still have $150,000 because you have to pay your tax bill. Now in the Roth IRA, that $150,000 is tax-free. So let's take this one step further. Let's pretend you wanted to buy your dream lake house with this money, and you withdraw $150,000 from both accounts. If you do it in the pre-tax traditional IRA bucket, this has a very high probability of making your Social Security 85% taxable and your Medicare premiums to go up. So you've worked hard all your life. Now you're being penalized because you took out too much money, and you're in retirement and you want to enjoy it. That's the whole point of retirement, is to, live a purpose-filled and passion-filled life. And I know people who have gone out to go buy that lake house, but they've done it with their Roth IRA money because it didn't affect their Social Security. It didn't affect their Medicare premiums, and it came out tax-free. So this is something that will help you plan for. Now let's go into the widow's tax. And I want everyone to think about this for a second. This is not a pleasant question to ask, but if you're married, what do you think is the probability of you and your significant other to pass away on the same exact day? And I know you're probably thinking, well, probably not likely. There's probably a very small percentage for you and your spouse to pass away on the same day. It's highly unlikely that you both will pass away in the same year, let alone the same day. So in this example, I'm going to show you the tax consequences of what that looks like when someone could outlive their spouse for 10, 20, or 30 years. So for this example, we have a couple, husband and wife. They both worked, so they have Social Security. The husband had a pension. He had IRA money. And their total annual income in retirement was $96,000, which is great. They lived comfortably. They didn't have debt. They're very happy, very comfortable. Their total tax that they paid was $7,947. Not too bad. That's an 8.28% effective tax rate. That's livable, ladies and gentlemen. That's amazing. But unfortunately, the husband passed away. And here's what happened to the widow's tax situation after her husband passed away. So her Social Security went away. She naturally received her husband's because it was, for this scenario, it was higher. And the pension got cut in half because they chose the 50% survivor benefit. So now she has to withdraw more money out of their pre-tax IRA because they did not do any Roth IRA conversions before they retired or even in retirement, because she wanted to keep that same standard of living. I'm sure everyone here would think, can I stay in my house? Can I afford my lifestyle? They're going to be grieving, but there's always money questions. And For this scenario, her tax bill went up. She lost her standard deduction for her husband, so that got cut in half. And what that equates to for all our math wizards here is her effective tax rate jumped up to 14.65%. And that's a 77% increase on taxes. And if you think 10 years down the road, 20 years down the road, if you outlive your spouse that long, do you see the tax drag that this could have on your accounts? It could force you to pay a lot more in taxes than you may need to. So this is why we need to plan for this. And then this is my favorite part of the presentation. This is truly my favorite part because this is an actual couple who attended the same exact masterclass a couple years ago. So I'm going to give you a real life example. I've changed the names for confidentiality purposes. There's no last names, obviously, but I want to take you through what happened with some folks who came to the same exact class. So we have Jeff and Carol. At the time, Jeff was 66, Carol was 63. They were married, filing jointly. They had $66,000 of adjusted gross income. They saved really well. Now, they saved right around $4 million of money throughout their lifetime. They were savers, and that's great. And for the folks that I talked to in part 2 of this presentation, not everyone has $4 million, and that's okay. You don't need $4 million for us to talk in part 2. That's okay. But for these folks, they had $2.3 million in pre-tax IRA assets. So they're sitting on $2.3 million. But the question is, did they really have $2.3 million in those accounts? And the answer is no, because the government has a tax lien on that money. They haven't paid their taxes yet. So when Jeff and Carol and I sat down, what I did for them was a tax mapping strategy, just like what you're going to receive in part 2. And in that tax mapping strategy, I planned out from now until 2025 ideas to help them try and mitigate some of those taxes throughout the rest of their life. And in this tax mapping strategy, you can take this back to your advisor. Let's face it, everyone has one, and that's okay. But I'm here to help you realize, your opportunities for your future. And for this couple, the software showed us we should be doing a little bit over $1.4 million in recommended Roth IRA conversions between 2020 and 2025. And they agreed. And then we had multiple meetings after the initial one so that we could start putting these plans into place because their advisor never talked to them about this. And I want to show you the value of what we did for them. Now, I know this may be hard to read, so let's get up nice and close to your computer here. And the bar graph all the way to the right, you're going to see age 100. So I ran this analysis for them to live to age 100, both of them. And if that were to happen, because of the Roth IRA conversions that we're doing for them, that's going to increase their net worth and their value by over $6.3 million tax free. So this had a huge, huge tax implication in a good way for them. Now, I know what you're thinking. Not everyone has $4 million or 2.3 in pre-tax IRAs, and that's okay. But when I do this analysis for you, it's going to show you, is it going to make a 7-figure impact for your family? Is it a 6-figure impact for your family? I don't know yet, but we're going to figure that out together. And you could book your time, the bottom left-hand corner, click the blue box, set up part 2 of the presentation. I see some folks, multiple folks have done that already, so thank you. And Invest the time in yourself to understand what it means for your future to do Roth IRA conversions, because GDP has doubled in the past 3 years. Taxes are likely to increase in 2025. We have a couple years to plan for things. So I want to be a man of my word and keep us on time here. Here are the tools for tax control. You really want to diversify amongst different accounts, whether it's pre-tax IRAs. They do have a purpose, but not always. Roth IRAs, including Roth IRA conversions, should you be doing them, we'll show you if that makes sense or not. Non-qualified monies, the after-tax accounts. And when you're withdrawing money from your retirement accounts and your investment accounts, you want to understand the tax consequence before you do anything. And that's what I show folks. So you want to properly blend withdrawals from different accounts. Now, in part 2 of your one-on-one personal visit, everything's going to be about you. I just want to listen to you. I'm going to ask you some questions. It's not going to be intrusive. It's going to be very simple. Let's keep things simple. And these are the most common questions that I get asked about our first meeting together. People ask me, well, what's going to happen? And I'm just going to ask you some questions about, what's your experience been with your financial professional? What are your goals? What would you like to see happen from a taxation standpoint in retirement? What does your future look like? People always ask me, what do I need to bring? Where are we going to meet? Well, we could meet in a multitude of different ways. If you want to do a phone call, we'll do a phone call. If you want to meet in person, I'm happy to meet in person. Absolutely happy to meet with folks in person again. Vaccinated, all good to go there. And we could also do a Zoom call or a Skype call. So we have multiple opportunities to meet in the fashion that suits you the best. And what will you need to bring? Part 1, you don't need to bring anything. We're just going to talk. Let's just have a conversation. Let's see if we like talking with each other, see if it's a right fit. But we're also going to be doing the tax mapping strategy for you. So eventually you will need to do some of your investment statements and your past PDF of your tax documents so that we could run that analysis for you to show you the impact of what Roth IRA conversions would look like for you. So really, all you're doing is investing your time because there's no cost to do this. And lastly, are you going to try and sell me anything? Absolutely not. I'm not here to sell any product, nothing of that sense. It's just to show you the opportunities that may be there for you from a tax perspective in retirement. And here's the agenda of our one-on-one meeting. And please be booking that right now in the bottom left-hand corner. I'm going to ask you questions about, where's your paycheck coming from in retirement? Or if you're not retired, where would you like your paycheck to come from? Do you want to be taxed or receive tax-free money? I'm going to show you whether your taxes are on sale or not in part 2 of this presentation. And that's going to happen in the tax mapping strategy. And number 3, are your investments structured in the most tax efficient manner? And I'm going to take you through ideas that can show you if they are or not. So invest some time today with me so that we can really show you how you could have a bigger and better future from a taxation standpoint in retirement. So almost everyone has booked their complimentary one-on-one mini consultation. And as I love to say, retire as you desire is the ability to live with lifetime income from your personally invested resources. Retire as you desire is a lifestyle. It's a choice. I want you to have a purpose-filled and passion-filled life so that you can enjoy it. And a big part of that is your taxes in retirement. So thank you so much for allowing me to educate you today. Please check out our podcast, our free books on the website, but most importantly, invest in yourself and book your 15-minute mini consultation for the part 2 of the tax mapping strategy. I'm so excited to meet with all of you, and I can't wait to speak with you. Have a great day.